Got trading having been extremely volatile following the currency move from the Swiss central bank. We are seeing the ripple effects throughout global markets today, from stocks to bonds, commodities. We're covering every angle. Mark Okada, Liz Ann Saunders is with me. Liz McDonald still here. Plus, Hedgeye Risk Management CEO Keith McCullough in the house as well. At the CME Group, Phil Flynn of Price Futures Group also joining us. Keith, good to see you.
Thanks for having me back.
So once again, the 10-year dropping. Obviously, this has been your call. You've been right on the money. What is this telling us?
I think the jobs picture is next up on the docket for people to be concerned about. So we had global growth slowing and deflation. That's much more of a global macro call that we've been making. We thought the Fed would have to react in kind to that. And now we have a job situation in the energy space, which you, Maria, have absolutely nailed in terms of reporting. That is starting to take off in terms of firings. And again, that happens on a lag. So I think you kind of wake up now and you say, lower bond yields, are jobless claims rising? Are earnings going to be as good with deflation? Because again, that comes out of the top line, gives you some margin compression for companies. And then finally, Europe, which you can't ignore. What is Draghi going to do next week? And if you can't get it done, I think those three things are telling you why the bond yield's got 1.7 in front of it on the 10s today.
And of course, we see these moves from the Swiss central bank ahead of Draghi. So connect the dots for us why we should care about what happened yesterday in terms of the currency market.
Well, I mean, look, I mean, these people, and I've always thought this, I mean, in the end, central planning, the great experiment, doesn't work. And it doesn't work in economic terms. So again, I think what they're struggling with is specifically that. They might get, stock market rally, they might get bonds at all-time highs in Germany, but they're not getting the wood, which is inflation in Europe. So again, they come out with a reactionary, really a surprise, a lot of margin calls in the currency market. But the real surprise was also in the equity market. Swiss equities now down 12% to start the year, down 6% this morning. So again, what is the next central plan? If that's the reaction to the next central plan in Europe, that's going to scare some people too.
Do I want to avoid Europe even more after this?
We're not optimistic on Europe, although you could possibly be getting at an inflection point. And to Keith's point, regardless of if the ECB does QE, whether it's the elixir for what ails Europe from a fundamental economic standpoint, and I don't think it is. I don't think it's the trigger for inflation. But could it boost financial markets like it's done in other areas?
Absolutely.
Of course.
Yeah, I think you're right there. I think that if they continue to push the euro down, which looks like that's the game plan here, this is not a fundamental story. This is really a price story, right? So stocks can certainly move up as this move from QE moves into the European theater. So staying away would probably be a problem unless you want to play those stocks. But again, we're going to have a lot of volatility. And to the point about Europe as a country or as an area and their growth, I think it's going to look more like Japan. I think you're really not going to have the growth coming from this. We're not going to get the stimulus. It doesn't work. QE really doesn't work fundamentally. You don't get inflation. You don't get jobs.
Well, think about it. I mean, they really want, and to be clear, it's kind of like fleecing the populace because people don't actually know what the difference is between nominal and real growth.
Right.
So they're trying to get nominal. They're trying to get inflation.
Right.
And Japan has taught you that they can't get nominal.
Right. Yeah.
So now you got Europe, and they're going to try to get nominal, and they're going to get what Japan got, which is no nominal. And when you have no nominal, this is basically the point. After all the different quantitative easings, policies to inflate, you have the deflation.
Right.
And that is easily the most obvious risk that we've been looking at in markets worldwide, across commodities to bond yields and back again, since really October.
Look at what happened to a firm like FXCM. I mean, in a nanosecond, the firm plummets in terms of its value. You've got some players just closing. It's really been extraordinary. Meanwhile, the energy story, Keith and I have been talking about the negative implications of falling oil. Phil Flynn, we've been talking so much about how great low gasoline prices are for the consumer, and now we're getting more evidence that, in fact, this is not all, to quote my friend Keith here, rainbows and puppy dogs.
You are absolutely correct, Maria. And I'll tell you what, even Christine Lagarde yesterday came out and said, hey, before she was like saying this is a net positive for the economy, now she's saying it's not going to be enough. It's not going to be enough to offset weakening growth around the globe, and the market is reacting to that. But surprisingly enough, today these oil prices are rocketing back up here. We just rallied about a $0.50 on crude. We're up about 90 points right now. And part of that comes from the International Energy Agency that put out a report overnight. Basically what they came out and said, listen, we don't see an imminent increase in prices coming anytime soon, but the tide is turning because of these cutbacks in production, because of what Liz McDonald said, what's happening at Halliburton, and all this cutback in capital spending. We're sowing the seeds for a new bull market in the future. Those comments have the oil going up, despite the fact that the dollar is rallying against the euro very close to another 11-year low. That's giving this market going up. Also to note, there's a lot of nervousness going into the gold right now. Gold was lower on the day, but the concerns about what's happening with the Swiss franc and some of these trading firms is getting a little bit more nervousness. So we're seeing a run back into the treasuries. We're seeing the safe haven into gold, and a lot of nervousness ahead of the ECB meeting next week.
Yeah, Liz Ann said she's not ready to go all in on energy. Mark is being real selective and coy as far as what he's doing, like Anadarko. Do you want to take advantage of some of these valuations in energy at this point, or it's a falling knife?
Cheap gets cheaper when you have deflation. I mean, our call has been consistent: deflation, short energy, late cycle stocks, which include financials and industrials. So again, you could get a big bounce in gold and energy. Going into Draghi, just play it out. If the central planning policy isn't enough, Paul Tudor Jones would say, what is the trade? From 116 in the euro, what's the trade? Are you going to short it for 115? If he doesn't do enough, you can get 118. If the euro goes up that day, oil's going up, gold's going up. Yeah. And I think that the gold market in particular is front-running that. Yesterday was a huge move in gold with volume. So again, I like to see that. Price up, volume up, volatility down. That's what gold did yesterday. Sure. It's telling me that the central planners are going to disappoint.
Yeah. I think he's right. I think you're right, Keith. You know, there's certainly a lot of crowded trades out there, and we've got to be really watching the crowded trades, and the strong dollar is a crowded trade, right? And if that goes the other way, you've got oil spiking too. So it's going to be interesting to watch what happens next week, and I do think that they disappoint. I think that it's really tied to conditions that maybe some people can't meet.
So, okay, so Thursday's the day. Liz McDonald, that's going to be the topic du jour going into Thursday. What happens at the ECB? Mark's here saying it's going to disappoint markets.
Disappoint market. We know, I talk to and get emails from my guys on Wall Street whether or not that will disappoint the markets. What they're really talking about with what the ECB is doing is how there is a growing groundswell on the part of ECB bankers that, yes, we should do this stimulus. And by the way, the Swiss national government, the central bank rather, was a big buyer of EU bonds. Now you've got the ECB possibly stepping in. So the markets may like that. Two other things, Maria, that they're talking about on Wall Street is what happened with this. We were talking about, you know, what's going on in the oil and energy sector. KeyBank is saying that the oil and gas U.S. sector can't sustain their workforces at this level. They may see more job cuts. The CRB Raw Industrials Index, which doesn't have petroleum or lumber, fell out of bed on December 16th. It had been range-bound since 2011. It's now nearing July 2010 levels. And on top of this, you've got the Deutsche Bank top economist saying the yield curve is starting to invert, and that's an indicator of possible downturn down the road. It's correct. When that yield curve inverts, it's basically predicted recession 7 times since 1970. The Federal Reserve watches that one.
This is the kind of stuff that actually can, you know, become a vicious cycle and get worse and worse. We've already seen, what, 4 oil companies cut jobs, and with oil continuing, I mean, it's up today, and oil stocks are actually leading in this market with the Dow up 31 points, but it doesn't feel like it's bottomed out.
And the other thing that Liz said is critical. What if the Fed makes a policy mistake? What if consensus, which has been completely wrong on interest rates, gets the Fed to move? The Fed is a completely politicized animal. If she'll look like, I think she will look like Trichet looked in 08. She will raise rates while global growth and deflation is pervasive. That could pancake the yield curve. Pancaking the yield curve is a very big problem. I mean, that is a clean-cut recessionary signal. I'm not making a recessionary call, but if she makes a policy mistake and if she raises rates, that would be the way you get a recession.
See, and I still believe in your call that rates go lower. I don't know if she's going to raise rates in 2015. I know the whole betting is, you know, June, maybe September. Look at where we are, guys.
Yeah, I agree. I mean, we outlined this in our macro themes call last week, which is what she should do is get out of the way. Go to 2016 and have yourself a coffee. I mean, what she could do is very different than what she should do. And if she makes a policy mistake, this was one of the key mistakes that policymakers, again, made in 2008 with Trichet acting preemptively.
All right, good conversation, everybody. Really appreciate your time.